Hello, everyone, and welcome back to the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman, and with me today is Ben Raygor. Ben is the owner of Raygor Tax in Rochester, Minnesota, who he just informed me is home of the Mayo Clinic. Welcome back to the show, Ben.
Thanks for having me.
Yeah, so I appreciate you coming on, Ben. When this podcast comes out, I think we're going to be firmly in the fourth quarter of 25. And that's when we kind of kick into some year-end processes. We're going to be, messaging out owner statements that we're going to be producing those at the end of the year and kind of getting everything prepped, 1099 preparation. There's a whole slew of processes we go through to make sure those are delivered correctly. And so while we're not at the end of the year, we're getting to the end of the year. And I thought it made sense to bring you on and talk about this. Taxes, tax planning. It may not be like the most fun topic to go over for investors, but it's really important for real estate investors to understand taxes on a number of different levels. So before we get into this, Ben, give everyone a quick rundown of what Raygor Tax is all about.
Yeah, thanks, Jeremy. My firm is exclusively focused on serving real estate investors all over the country. And I grew up in a family of real estate investors. My dad and my brother have been full-time investors for over 10 years, probably. And when I was starting my own business, I knew I wanted to focus on one industry and be an expert in that area and make sure we can serve them really well. And that's why we picked real estate. And so I love the variety that we get within real estate. There's so many ways to get into a deal, so many ways to come out of it and exit it. And there's tax planning all along the way, especially at the beginning and at the end, but also in the middle.
Yeah.
So it's super exciting, I guess, to connect me with a lot of people. And I think there's a lot of opportunities just for people to accomplish their tax goals in line with their investing goals of how they want to spend their capital and how they want to spend their time. And so it's exciting to have calls with clients where we try to figure out what's the sweet spot for each individual investor.
Yeah, that's good. So Ben, we're big supporters of the 5 profit centers. Everyone, and we talk about this ad nauseum on this podcast, but everyone's so focused on cash flow, and cash flow increasingly is an impossibility to achieve on a year-to-year basis, especially early on in the investment. And we always talk about the other areas where real estate, in my mind, is much more powerful and can create wealth. But one of those, just kind of on an everyday basis, every year basis, is the tax advantages that real estate investors get. So for people that are thinking about investing or not real clear about, the power of taxes and what it can do for them, or maybe people think they know what it is and maybe don't have a full concept of what taxes can do, give everyone kind of an overview of just all the tax advantages you gain as owning real estate.
Yeah. I would start with the ideal scenario. Okay. And the ideal scenario is that someone buys a piece of real estate, whether it's their home or a rental property, and it appreciates in value. And someday later on down the road, more than a year later, you sell it for more money. And there's what's called long-term capital gains, which are automatically taxed at a lower marginal tax rate than what W-2 income is, or self-employed commission type income is, or even interest income is. Okay, that's at your highest marginal rate, but long-term capital gains are at a lower rate. For some people in the middle class, it might be taxed at 0%, or a portion that might be. For others, it might be 15%. You can get into the top 20% bracket for long-term capital gains, but that's a lot less than the 30s for a tax rate. And so that's first of all, it's one of the most tax efficient forms of income you can have, assuming that you make money on that and have a capital gain, right? Sell it for more than you bought it for. So that's the first thing that we're hoping is going to be the case.
And it's a 1 year, I should know this, but it's 1 year is where you have to hold it before those long-term capital gains kick in.
Yep. As soon as you hit a year, then you're free to sell it. So people always say a year and a day.
Okay.
Yep.
All right. And then on a day-to-day basis and an annual basis with other tax benefits, kind of go into that.
With some of the other things that show up, if you read articles online or hear a guru talk, you're probably going to hear the word depreciation. Okay,
Yep.
and that's where it starts to sound pretty fancy, uh, and so there's a lot we could go into there, but in short, it's what we call a paper deduction because you buy a property, you can depreciate the building over the life of the building, which for tax purposes might be 27 and a half years, or it might be 39 years, depending on the use. But every year on your tax return, you've got rent income minus your operating expenses, minus depreciation that shows up. And so it decreases your taxable income. So I've had a lot of clients who actually cash flow positive, but then because depreciation shows up on their tax return, they have less taxable income than what their cash flow was. That's what would hopefully be the case for
Yep.
people. Might depend on what your principal pay down is throughout the year. And there's various factors, but that can be the reality for a lot of people where once you've bought the property and you kind of set aside the whole down payment part, and now going forward, all of a sudden, this depreciation deduction helps wipe out that taxable income that you normally would get from your cash flow. So that's something a lot of our clients see is something on an annual basis where, well, isn't this rental income going to kill me on my tax return? Probably not. And if it does, it means you're killing it with a profitable property, and that's good news too. And we can
Yeah. We've, we bought our properties a long time ago and we had, some positive cash flow. So you're right. At the end of the year, it could pencil out to where, oh, this LLC that we had on the property in made money. And then we'd send it off to our accountant. He'd give us our depreciation entry and we didn't make money. So it wiped out that burden, the tax burden that we would have had. So it was a wonderful thing how, it didn't happen every year, but some years we were cash flow positive, but we could never on paper, from the IRS's perspective, make money. And that shielded us from having to pay from having to pay ordinary income on that rental income, through a K-1 that we'd get at the end of the year.
Yeah.
So
Something else I'll just add in, as far as kind of normal deductions that show up, and this again can be more advanced and something to talk about with a tax person someday, but once you have a property that's maybe had a tenant living in it, and maybe they move out, and then you're used to hearing, considering things like, oh, we got turnover. Now we're going to make some updates before we list it for rent again to get a new tenant in there. Maybe we want to improve it so we can bump up the rent. A lot of those improvements now, there's a lot of tax efficiencies that we can go after there where we might be able to just simply expense a lot of those small improvements. And that can be really powerful on the tax return.
sure.
Or like, okay, we replace all the appliances, but because of technical parts of the code, we can just simply expense them. We don't have to capitalize and depreciate forever. So that's another area that kind of goes alongside depreciation that has to do with the improvements of the property that we look to see where can we, how can we make sure that we do a renovation, like a big renovation in the most tax efficient way possible. And that's type of stuff we like to talk about too. So anytime you're looking to spend big money on renovation stuff, that's where it might be helpful to talk it through with someone.
Do you have a rule of thumb, going down this path a little further on, hey, you can expense a refrigerator, but you can't expense flooring, or you can expense light fixtures, but you can't expense, a bathroom remodel. I'm just throwing that things
Yeah.
out there. Do you have rules of thumb for people, or is it just kind of how aggressive you want to be from an expense standpoint?
It's like a big nested if function, if this, then that, but even though within that, yes, answer, if this, then that. And so first of all, I'll just say there's this phrase you might need to know someday about it's important that a property is placed in service already, meaning it's already ready and available for rent. Once we've reached that status, then it opens up the opportunity to expense a lot of small improvements, which is way better from a tax return standpoint.
Right.
And so that could be the most common threshold is the $2,500 de minimis safe harbor threshold. That's in the tax code. And so a refrigerator is, if it's a $1,000 refrigerator, okay, that's an improvement. But because that improvement is less than 2,500, we can expense it.
Gotcha.
So new cabinets, you're probably going to spend more than 2,500.
Yeah.
And so that gets capitalized and we depreciate it over the life of that asset. But that might be the case with countertops. But if you know how to install something yourself and you buy $2,000 worth of countertop material, you can just install it. And the cost of that countertop was only $2,000.
Oh,
But if you pay a general contractor to come and do it all and their labor and materials, you don't care what their breakdown is for that. But if they spend $4,000 on those countertops, you have to capitalize it. So less powerful in the current year, you'll still get that deduction eventually.
yeah.
So we don't want to say chase the deductions as the top priority, right? And still just spend the money on stuff that makes sense to spend your money on. I'll be one of the last people to say everyone should go buy a new vehicle for the tax write-off. Like, that's the right fit for some people, but not for everyone.
Right. So you mentioned something, Ben, about when you get it in service. Okay. So let's say I buy a home, I do a lot of value add stuff, maybe a kitchen, bath, whatever. Place a tenant, and then 3 years down the road, I have to replace the furnace. Call it, let's say, a new HVAC system. I've done a lot of that recently in our own portfolio. But let's say it's $8,000. I'm assuming that is not an expensable.
You said it's $8,000?
Yeah.
Yeah, that would most likely be an improvement to the
Yeah.
property.
So even though it's in service, it's still over that
Yeah,
$2,500 correction.
There's a distinction between improvements versus repairs versus maintenance.
Gotcha.
And those three categories on the Schedule E of the tax return where rental activity is reported. There's a line for maintenance, there's a line for repairs, and then improvements to be capitalized are somewhere else. And so sometimes you do just have expensive maintenance, like paying someone $3,000 to come and do pest preventive measures and stuff that only last for a year, and then they got to come and do it again. It's expensive, but it's a maintenance expense, maybe not necessarily an improvement. Okay. Most likely with the HVAC part, you're replacing enough material components of the thing that you're definitely improving the property in a way that should theoretically increase the value compared to what it was like before. But that's different than paying someone $3,000 to come and patch 10 holes that some party goers punched in the wall. That's not an improvement. Now you just have an expensive repair bill.
Yeah. Gotcha.
Fully deductible in
Okay.
the normal sense.
So let's take on, I know depreciation isn't necessarily super exciting, but let's stay on this for another minute. The big, beautiful bill has some different ways people can depreciate. Can you kind of get into that and I guess give me your opinion on the wisdom behind it, or if you think it makes sense or not? I'm just kind of curious your perspective.
And so bonus depreciation was 100% back in 2022. Then it dropped to 80%, then 60%. It was going to be 40% for all of this year until the bill was signed, and now it's back up to 100% for most of the year. And what that means, okay, is some types of assets can qualify for bonus depreciation. Not all assets. So you can't just buy a building and bonus depreciate it. But there might be components in that building that could be bonus depreciated. Appliances and vinyl plank flooring are good examples of they have a depreciable life of 5 years, which means they qualify for bonus depreciation. And so that would be something where if I spent $4,000 on vinyl plank flooring, kind of the stuff that you can remove and move around easily, as opposed to hardwood flooring, but that could result in a $4,000 depreciation deduction showing up on my tax return, and that can be really powerful.
Nice.
So that's a big deal if you're doing renovations, or if you decide I want to pay money to order a cost segregation study for this property that I newly acquired. And I'm hoping that kind of as much as possible of the total building basis, I'm hoping like 20 to 25% of the building basis gets allocated to bonus depreciable property components. And you get an engineering firm involved to help with that. And so that's something a lot of my clients are interested in.
So Ben, I think it'd be a neat exercise if you went through and kind of modeled out. You talked about how there's a lot of tax advantages when you buy, when you sell, that's where taxes really, come into play a lot. Someone's thinking out there thinking, I might want to buy a rental property. So can you give them a playbook? And we won't spend too much time on this, but kind of say, again, looking at through the lens of a tax professional, like this is how I would set you up. This is how you should run things on a day to day. And this is what you need to be thinking about. Because ultimately, most real estate is sold, right? I mean, I guess you can die with it. It's going to go to your heirs, which is a normal, it could be a very intentional way people deal with real estate. But can you kind of work through like the beginning and to the end of the life cycle and how you think it should run best from a tax perspective?
And we're going to assume that this is someone's first rental property.
Yeah, let's say that like it's the first rental property, and let's just model it out to where if you're advising someone today, like this is how I would suggest you organize yourself, run your business on a day to day, and then ultimately dispose of it.
All right. Yeah, for starting it out, one of the things that I like to do is help clear the air about how people should own their real estate. And so some people hear someone say, oh, I got to have a family partnership based out of Wyoming that manages my Delaware statutory trust that is all run by a C corporation that employs my children. It's just really complicated guru stuff that it's like, okay, we gotta keep it simple, okay? Because you can get complicated really fast and not actually understand what benefit it provides. And so I want to keep things simple. So a lot of people, when it's their first rental property, this isn't legal advice, right? But it's oftentimes relatively a low risk to own a property in your personal name. I have nothing against LLCs, though. I love it when people own properties in single member LLCs. Okay, that's pretty basic from a tax reporting standpoint. And an LLC might give you the legal protection you need to help you sleep better at night. You also got to talk with insurance agents about umbrella policies and things like that. And so you got to figure out what's going to work well for you, as far as, administrative cost to implement it, what protection it provides, and what, in the worst case scenario, and how you're running your activities. So there's stuff like that. But in general, again, I try to err on the side of keeping things simple and easy to understand where possible. From there, you're supposed to analyze the property from what is the cash flow expected to be. It could be a property that you think, hey, this is in an up and coming neighborhood. I'm really looking for that appreciation in the future. And if that's the case at the expense of cash flow that you can live off of, you got to have a game plan to cover yourself if you have a month of vacancy and now you don't have the cash flow from the property for that year to cover your mortgage and utilities expenses and taxes and insurance for that month, right? And so, yeah, you got to consider the cost of owning and consider the risks and make sure that you have the bandwidth, the margin in the rest of your financial situation for that to work well, okay? And so I've got clients that vary as far as they only buy properties that they really think will cash flow well because they don't want to have to cover its expenses from over here, right? You don't want to be tempted to pull early from the retirement account as a reaction to cover negative cash flow in a rental. And so you just need to consider all of that stuff. And so I don't do too much advising about analyzing the property for my clients and saying this isn't a good deal. You got to do that work, right? And seek counsel where you need to, for sure. But then I would say, hey, depending on your situation now, let's look at whether or not it makes sense for you to do a cost-based study. That could depend on whether or not you could qualify as a real estate professional, or if it's a short-term rental that you materially participate in. There are some exceptions that might allow you to get a big fat tax deduction this year in your tax return and giving you a nice refund when your tax return is filed. That might be the case for some. Don't assume it's the case for you unless you've sought counsel and know it applies. But otherwise, aside from that moment, kind of the length of your ownership is hopefully going to be pretty simple for that property. It's cash flow, and we look at principal and depreciation to figure out now what your actual taxable income is. And it's hopefully pretty straightforward until you get to the exit strategy of, hey, I think it's a good time for me to sell this, whether because it's just people are making me offers I can't refuse, or I want to take that equity and I want to move it somewhere else. Some people decide, instead of selling the property that I have a lot of equity in, I'm just going to refinance it.
Yeah.
And use those loan proceeds for something else. That that could be fine. Other people decide I'm going to sell it and kind of reposition my wealth. And so when we get to selling, then that's a good time to talk about, do we sell it outright and just recognize the tax hit and depreciation recapture in the year of sale? Some people get excited about deferring that capital gain further down the road, and that's what a 1031 exchange is about. There's a bunch of rules about how to fulfill the requirements to do it, but that can be a powerful thing to sell a property, it reinvest the proceeds into rental real estate again, and not have to pay a dime of taxes related to the sale of that property this year. That could be a good fit for some people. If they've owned the property for 30 years and they've paid off the mortgage, they've got the option to maybe do seller financing. If they're like, I want to sell it, but I don't want to recognize the whole hit this year, and I can afford to spread out the sales proceeds that are going to come to me. And some buyers are looking to buy properties from people who can work with them from the seller financing standpoint. And that can help spread out that capital gain recognition. And so sometimes I've got some clients where that's a really powerful planning tool, where depending on their marginal tax bracket, they're trying to spread it out so that they pay 0% federal long-term capital gains every year on it, rather than sell it and recognize all the income this year at their marginal tax brackets.
Gotcha.
So those are a lot of the things that I try to plan through with people.
Yeah, there's a lot there. I want to touch on a few points you made. So, Ben, you're saying that initially you're not going to necessarily really push people into forming an LLC on property one. That seems like that's kind of what I heard from you. Is there a time? I mean, do you have a rule of thumb that says, hey, once you acquire 4 properties or 5 properties or whatever it is, that you need to think about this for protecting standpoint? I mean, or not? You kind of let that be the individual, because everyone has different levels of risk, right? And so
I have some clients who buy high-end properties, and it's one LLC for each property. If you're in California, they got this franchise tax fee for every LLC in existence that is $800 a year. Like, oh, that's an expensive administrative burden every year just to keep that LLC open. Where I'm at in Minnesota, it's really cheap to have free on an annual basis to have an LLC in existence that generates less than $1 million in revenue, for example, or doesn't hold that much in assets. And so not a big deal to have an LLC then, just the one-time setup cost. And so you want to consider what state you're in and what the annual renewal looks like. But in general, I do have clients who vary. Some are like, hey, once I get about $1 million in worth of real estate in an LLC, I might want to do a separate LLC for the next batch of properties. Some people would say, I'm not worried about the dollar amount. Once I hit 10 properties in one LLC, then I'm going to switch to a different one. Some don't care at all. Some are just, I'm going to do it in my personal name, and I'm going to have a lot of umbrella insurance policy to cover the worst case scenario. And that gives me the peace of mind to sleep well at night. And so everyone can vary. The main thing with LLCs that I want to say is it's generally not a tax strategy for real estate, for rental property investing purposes. Okay.
All right.
Having your property in an LLC doesn't give you all these tax deductions. It's pretty much just the same as if you owned it in your personal name.
Yeah.
And so you do it considering the legal benefits and the administrative cost and time, right? If you have an LLC, you got to run it properly if you want it to accomplish, in a worst case scenario, what you want it to. If you were brought to court, right? You got to actually have a separate checking account. You got to own the property in the name of the LLC. That might be a commercial interest rate rather than a personal interest rate. You got to actually run a separate checking account and do the finances properly, and can't just be all over the place. And so and a lot of people realize, oh, wow, that's a lot of work. Maybe I didn't really want all that work. So if you want to save the day, you gotta do the work.
That's some good points. I remember, I think it was maybe the first time we had a meeting with our tax representative. We don't use this guy anymore. It was a long time ago. And we went into his office, and he said, wow, most real estate investors bring me a shoebox with receipts and invoices folded up. And, I kind of have to piece it together. We actually started using QuickBooks, I think from day one. That's something it was like a desktop version. There was no online versions back then, really. But that leads me to a question. What do you see? I mean, do you see what do you see as best practices to manage the day-to-day expenses and income that rental properties are going to generate?
We work with a lot of small real estate investors. And so it's a lot of people who have 3 or less properties and a lot of people who have more or a lot more than that. The more you get, the more important it is to probably use maybe a paid software subscription option that gives you a lot more power to help you stay organized, right? Bank feeds automatically pull in all your transactions into here. And maybe there's rules in place that help automatically categorize stuff. Maybe you need to go in and just kind of check it off and make sure, yep, that expense was for repairs. And then you got to say which property it was for. And that's a powerful feature. In QuickBooks, we call that class tracking. So that then you can go to reports and see a profit and loss report, a P&L, an income statement sorted by class, which means now I can see for each of my 5 properties, there's a nice P&L report that I can give to the tax guy to use for the tax so that they don't have to charge me for a bunch of bookkeeping and cleanup stuff.
Right.
For some of my smaller clients though, who are 1 to 3 properties, I'm like, hey, some of the software options that are really good, pretty expensive, and you can scale into the cost the more properties you get, because the subscription might be a fixed monthly price,
Right.
whether you have 1 property or 30 properties.
Mhm.
And so I typically tell my clients, I'm like, hey, once you get over 3 properties, I'll be more likely to encourage you to consider a good software option. Otherwise, use a good Google Sheet template, and we can coach you on how to use our template where, download your credit card and checking account transactions to a CSV file, carefully copy and paste it into our G Sheet template, and now it's ready for you to go to each transaction and select what category the expense is and which property it was for. And then it generates a nice report. So we try to, I encourage people to just figure out what works for you so that you can have a year-end P&L report for each
Right.
property.
Right.
That's what you need to accomplish from your own internal management standpoint, as well as what you would maybe give to a lender someday, or for tax return purposes. That's what your bookkeeping needs to accomplish.
Gotcha.
Whether you do that manually on your own Excel sheet, or use a good Google Sheet or a software program, I don't really care how you get there. You got to figure out what works.
Yeah. I just think it's helpful to stay organized so you can, if it's a truly good expense, you need to make sure it's recorded and so you can benefit from that.
You can the shoebox of receipts. Let's try to get rid of those days. Okay, when you get a receipt, use some app on your phone. I use Adobe Scan on my phone. Could use the QuickBooks app if I'm paying for that. Okay, but digitize it, because guess what? Sometimes those restaurant receipts can fade out, and the IRS wants to know who were you with and what was the business purpose of that meal expense that you want to write off. You got to write on it with pen, maybe, if you want to be able to defend this deduction if the IRS audits you on that one. A lot of other things, not as big of a deal, but I know a lot of invoices are emailed to us and they're already digitized, which is good. But if you get those paper receipts, just try to find a way to digitize it. They're in the cloud somewhere. And then if you lose the receipt, not a big deal.
Right. Then you mentioned this status of a real estate professional, and it's something that we've never had to worry about. Scott and I are, our business, because we've always, for the last many, many years, have been full-time. We own a real estate property management business. And so we've never had trouble qualifying for that. But can you talk about that? So, because I'm guessing, like most of our clients, most of your clients, this isn't their full-time job, right? So they have a 9 to 5, whatever that looks like, and they own 3 or 4 rental properties. And so talk about qualifying for that, how they can do it, and then the benefits. And if you can't, what that means, I guess.
Let's start with the benefits, and which, before we get to the benefit, it's understanding the basics of the tax code. So rental real estate by nature is considered a passive activity per the tax code. Okay. And so if you have $50,000 in net rental loss for the year, let's say it was just vacant for a long time, or there's a lot of deductible renovations, just worked out. Okay. Or maybe you had a bunch of depreciation that resulted in a net rental loss. But let's say it's $50,000 for a normal person. The government says, hey, that's a passive activity. And at most, a normal person could only deduct maybe $25,000 in the current year. There's a $25,000 rental activity loss limitation. Okay. And so if I make $100,000 as a W-2 employee, I'm a single guy, I got my first 3 rental properties and I got a $50,000 loss, the IRS would tell me the tax return, it would say, you can deduct $25,000 this year. Okay, that's cool. The remaining 25,000 is suspended and carried forward to future years. It's not use it or lose it. It's use it or defer it. And so
Okay.
all of this with rental real estate, when we talk about the losses, if it's not deductible, it's just deferred, okay? Or about front loading depreciation, it's cool to do that, to get a deduction today, but guess what? You would get that deduction eventually.
Right.
And so that makes it less powerful than what we call a credit or something like that, where it just hits today and not necessarily in the future the same way. So that's what rental real estate is by nature. So real estate professional status, though, is something that makes it so, hey, that $50,000 loss can be fully deductible in the current year if you meet the requirements. There's a bunch of them, 2 big ones, okay? But if you meet these requirements, that would allow you to fully deduct and bring down your taxable income by that full $50,000, for example, okay? And so we get some people, let's say you got 2 doctors, okay? Taxpayer and spouse, they both make, I don't know, let's just say $200,000, so $400,000 in income. They're phased out of being able to deduct even $25,000 at that point, okay?
Mm.
So their passive losses are totally suspended and will be carried forward. Okay, unless now one of them could decide, I'm going to quit being a doctor and I'm going to become a real estate professional. I'm going to spend over 750 hours on qualified real estate activity. That could be managing rentals, it could be flipping properties, being a real estate agent. Okay. And requirement number 2 is that we, taxpayer and spouse, materially participate in our long-term rental portfolio by spending maybe at least 500 hours or 100 hours or more than others. There's like 7 different ways you can meet the material participation test, but it takes a lot of work. Okay. You have to do substantially all the work, or you have to put in just enough hours, like hundreds of hours. And if that is the case, right, if one person is a real estate professional, and the 2 of you combined, if you're married, meet the material participation requirements, then that allows you to treat those what would be passive rental losses. You can treat them as non-passive, which is what makes them deductible. So now, okay, this doctor income from one spouse is offset by these deductible rental losses now.
Mhm.
And it brings the taxable income way down. And that's where it gets really powerful and attractive. And so the gurus will tell you, yeah, just qualify as a real estate professional and offset all that income. It's really, I don't know if they always say it's really easy, but it's kind of complicated. And so I do have to sometimes dispel the myth about, okay, do you actually understand what it takes to meet this requirement? But if you do, it can be super powerful.
Yeah.
Absolutely. One other thing I'll clarify is to be a real estate professional, you have to spend at least 750 hours in qualified real estate activity for the year. And your time in that real estate activity has to be more than your time spent in non-real estate activity. So I can't work a full-time job as a doctor or an accountant and qualify as a real estate professional. There's just not enough hours in the day to tell the
Really?
average.
Okay.
I
Interesting.
was a 2,000-hour accountant, and I spent 2,010 hours managing my rentals. They're just not going to believe that.
Okay.
It'd be tough to prove that, right? And so that's where usually it means one spouse maybe doesn't have a day job and they spend their time managing the rentals. And it's powerful if it helps offset another spouse's high W-2 income. That's the most common scenario of where real estate professional status is powerful. The other common scenario that I see with my clients is I work with a lot of real estate agents who are
Yeah.
full-time agents. That is a qualified real estate activity, but it's self-employed income. Okay. It's like a big fat W-2 income. But if they also do a bunch of rentals, their time spent managing the rentals can combine with their realtor hours to meet the 750-hour test. And then it's just a matter of, did you materially participate in your rentals and satisfy the requirements there? And that can be a common combination that I see. So real estate agents with rentals, or if you're a developer or a flipper or something, okay, but you've got this other non-rental income stream that's real estate related, and that can be offset by rental losses. Um, Not offset, that's not the best word, but your taxable income can be reduced on the
Mhm.
otherwise it's usually high income earners who are married and one spouse doesn't have the full-time day job and meets the requirements for a real estate professional. Those
Okay.
are two big scenarios.
What last question on that. Are there scenarios by which people who use property managers can still be considered real estate professionals?
We've seen that be the case. If you exclusively use property managers for all of your properties, that makes it a bit tougher
Mhm.
because you might not be managing the day-to-day activities of the property. And so it's tougher to get your hours log of time spent doing something that matters for the property. Your hours log still has to hit maybe 750 hours or maybe plus the material participation, which is 100 or 500 hours. You still would have to hit that by being involved in overseeing maybe some renovations or working with the property manager to accomplish those renovations or getting the property up and running. I've got some clients who manage the property themselves the first year to meet the material participation requirements, and they get that big deduction in the first year, but then in year two, they hand it off to a property manager.
Right.
And so yeah, we just need to be aware of the situation. Maybe your portfolio is big enough that you self-manage some and you use a property manager for the out-of-state ones or something. And maybe it works out that way where you don't have to materially participate in each property separately. Okay.
Gotcha.
And so you can combine your hours across your portfolio. So that could mean you have nothing to do with some random property that is managed by a property manager. But because you do enough with the whole portfolio, it could give you the favorable tax treatment across the board.
Gotcha. All right. I think this is my last question. We've been on here a while. I appreciate all your time, Ben. But when you have a lot of reps doing this, so you've done a lot of returns, you do a lot of advising. What do most people get wrong from a tax perspective when you're just like, oh, they shouldn't have done this? Like, what do you see where, some like pro tips of, you of what people get wrong and what your advice back to them is?
One of the first things I would say is uh, getting entity structuring wrong, or
Mm.
just at least having unintended consequences, like, oh, my wife and I formed a multi-member LLC to own our rental. Okay, you did that. There's no tax consequences, but did you know that you have to now file a partnership tax return?
Mm.
That the income passes through to your personal return, but that's a whole separate tax return filing obligation. You might have to pay more than $1,000 in tax prep fees. And did you realize that? Oh no, we didn't want that. We'll change it to a single member LLC instead.
Mm.
That would have been our intent. So sometimes just being quick to set up entity structuring that comes with unintended complexities or complications. It's hopefully not disastrous, but some people hear like, oh yeah, I heard that S corporation is the way to go for stuff. So I'm holding my rentals in an S corp. And I would say, no,
Yeah.
do that. Almost never should you hold rentals in a S corporation just because of some nuances to the tax code there. It might be okay, but
Mhm.
there's no benefit I'm aware. Why do that?
Yes.
There are certain things there where it's like, just talk to the right person before you fire away. Okay. We don't want to go too slow with ready, aim, 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 aim. And some people are always aiming, right?
Yeah.
Before firing. But you don't want to bring your tax accountant following behind you saying, slow down. You're making
Right.
many decisions without talking about it.
Yeah.
That would be one. Okay. Uh, what things people get wrong? When people try to do their taxes themselves, the first year of placing a property into service, that's usually the year where the most stuff gets messed up. Like, did you calculate the cost basis correctly? What about renovations? Maybe you bought it vacant, renovated it, and then you listed it for rent. And just kind of, did you handle all that stuff in the most tax efficient way? Sometimes stuff gets totally missed, and it's like, wow, you missed a lot of stuff, and this permanently hurts you. And we have to look at amending a return now to fix all your mistakes. Sometimes it's more just like, hey, you didn't understand the way the tax code works, and there's a more efficient way to do this.
Yeah.
So usually the first year property is in service is a big deal where people get all sorts of things wrong. But I guess one of the other things, though, when I go to the exit side of it now, some people get really excited about like a 1031 exchange. Who doesn't want to defer a tax liability down the road, right? If I get that money today, I can invest it, it'll grow, time value of money, we want that. But then I've had clients who went ahead and did that without consulting me first. And it's like, hey, your tax bill was going to be like $3,000. It wasn't actually going to be that high. And now you spent over $1,000 to do this 1031 exchange, and it added stress to you because you had to satisfy all the requirements, do this stuff. So some of it is talk to an advisor first. The stuff I see people getting wrong is mainly stuff like that. I'll say that's a bigger deal than me saying things like what people get wrong. Living in California or something like, no, that's not.
Yeah.
But I would say, hey, maybe if you have a bunch of assets, maybe don't just liquidate it in your retirement years before you maybe move to a no state income tax state. I would say, hey, maybe complete your move, change your residency before you liquidate your stock portfolio. That could be a huge thing too. But people have all sorts of reasons to live in any of the 50 states. And so that's not really a get it wrong thing, but there's tax planning opportunities if you want it.
Sure. Well, Ben, I appreciate you coming on here. I think you do great work. CPAs are very important. We tell people when you're building your team, CPAs have to be a piece of the puzzle because this is something I don't ever believe in outsourcing. We never have. We never advise people to do it. Let the professionals do what they're good at. And I think you more than pay for yourselves over time. So appreciate you coming on here.
Yeah, it's been my pleasure. Thanks for having me, Jeremy.
We hope everyone has picked up some information that will help them in their investing. We'll be back in 2 weeks with another podcast. In the meantime, we encourage you to share this podcast with your investing friends. Leave us a review and don't hesitate to reach out to us with any questions. Until next time, thank you so much for listening, and please stay invested in your investment.